Imagine this. Two people look at the same stock. One sees an exciting opportunity to get rich overnight. The other sees a dangerous trap that could wipe out savings. Who is right? Here is the twist. Both are looking at the same numbers, but only one of them knows how to read them. That difference between chasing illusions and uncovering truth is the difference between speculation and investment. And this is exactly where Security Analysis by Benjamin Graham and David Dodd steps in. This book is not about hot tips or guessing tomorrow's price. It is about learning a discipline, a framework, a lens that allows you to see the financial world with clarity. It is the playbook that Warren Buffett once called his Bible. But here is the catch. It does not promise instant wealth. It promises something more powerful: the ability to separate noise from value, to recognize when the market is lying, and to act with confidence when everyone else is confused. Why do some investors consistently survive crashes while others lose everything? Why do some portfolios grow steadily for decades while others burn out in one risky bet? The answer lies in one central idea that this book will unfold slowly. An idea so simple, yet so often ignored, that it can protect you against disaster while opening doors to wealth. What is it? And to discover it, you must journey through the pages ahead. Step by step, part by part, until the final revelation makes it crystal clear. The margin of safety. And the journey begins here. With Part 1, Survey and Approach, where Graham and Dodd set the stage by showing us the scope and limits of security analysis. They remind us of an uncomfortable truth. We cannot predict the future, but we can prepare for it. Part 1, Survey and Approach. Every great journey begins with a map. But what if the map itself has limits? What if the very tools we use to navigate investments can only take us so far? This is the puzzle Benjamin Graham and David Dodd placed before us at the start. Security analysis is powerful, but it is not perfect. It can reveal hidden truths, but it cannot promise certainty. Here lies the first challenge for every investor: to accept that knowledge has boundaries. And yet, within those boundaries lies immense power. The question is, how much can analysis really achieve? And where must caution begin? That is exactly what Chapter 1 explores: the scope and the limitations of security analysis. Chapter 1, Introduction, Scope and Limitations of Security Analysis. Every science has its limits. Even the most advanced tools cannot guarantee perfection. Security analysis is no different. It offers investors a way to think clearly about financial decisions, but it cannot eliminate uncertainty. Benjamin Graham and David Dodd open their classic by warning us: do not expect analysis to predict the future with certainty. Instead, expect it to create a logical foundation for making decisions. The role of the analyst is not fortune-telling. It is interpretation. It is careful judgment built on facts, not on wishes. The first step is to understand what security analysis is meant to do. It studies financial statements, balance sheets, income accounts, and company reports. It searches for the real strength and weaknesses of a business. Its goal is to find the truth behind the numbers. But here comes the limitation. Even the best analysis cannot foresee wars, political revolutions, sudden economic crises, or natural disasters. These unknowns are beyond the reach of numbers. So the analyst must remain humble. He must remember that markets can surprise anyone. Still, analysis has great value. It allows the investor to avoid blind speculation. It helps in separating companies with solid foundations from those built on illusions. It gives the investor a rational anchor in a sea of market emotions. Graham and Dodd emphasize discipline. The analyst cannot be swayed by hope, fear, or market noise. Instead, he must ask, is the company truly able to protect the investor's money? Does it have a record of stable earnings? Are its assets real and strong? If the answer is yes, then the security deserves attention. At the same time, analysis must remain flexible. The world changes. Industries rise and fall. Methods that worked in the past may not always work in the future. So the intelligent analyst adapts, but he never abandons the principles of logic, evidence, and caution. The authors also point out another important truth. Most mistakes in investing come not from lack of intelligence, but from overconfidence. People believe they can outsmart the market. They trust predictions that sound certain, but are built on weak foundations. Here, security analysis acts as a defense. It keeps the investor grounded in facts rather than fantasies. So what should we take from this first chapter? That security analysis is both powerful and limited. It cannot promise wealth, but it can prevent disaster. It cannot predict the future, but it can prepare us for it. And above all, it gives us the discipline to remain rational when others lose control. And now comes the natural question. If analysis is both powerful and limited, how exactly do we define its scope? What areas of finance can it truly master? And where must we admit its boundaries? These questions lead us directly into Chapter 2. The scope and limitations of security analysis continued. Chapter 2. The scope and limitations of security analysis continued. The second chapter deepens the discussion of what security analysis can and cannot do. Graham and Dodd remind us that the analyst is not a prophet. He is more like a doctor. A doctor cannot guarantee life, but he can diagnose, prevent, and improve chances of survival. In the same way, an analyst cannot guarantee profits, but he can diagnose weaknesses, avoid risks, and improve chances of success. The scope of security analysis lies in facts. Numbers do not lie, but they can be misread. The analyst's job is to test those numbers, compare them with reality, and build a logical conclusion. For example, if a company's earnings cover its interest many times over, that is a strong sign of safety. If assets are greater than debts, that provides protection. These are within the scope of analysis, but there are strict limitations. Analysis cannot account for political revolutions, sudden natural disasters, or unexpected human behavior. It cannot forecast the timing of booms or crashes. No formula can predict exactly when optimism will turn to panic. Therefore, the wise analyst does not try to predict everything. He accepts uncertainty and builds a margin of safety. The authors stress another key point. Security analysis works best when applied to groups of securities rather than single bets. Looking at one company may lead to mistakes, but examining a wide group gives a more reliable picture. Patterns and averages are more dependable than isolated cases. This is why Graham often relied on statistical studies of many companies, not just one. Another limitation is human emotion. Even when analysis shows danger, people often ignore it. During market bubbles, investors dismiss logic. They believe this time is different. In truth, no amount of analysis can protect someone who refuses to listen to reason. Yet despite all these boundaries, analysis remains essential. It is the compass that keeps investors from drifting aimlessly. It cannot guarantee the destination, but it can keep the ship away from rocks. So what is the lesson of this chapter? That security analysis has clear power, but only within defined territory. It is like a flashlight. It cannot light the whole forest, but it can guide you safely along the path in front of you. With this foundation, Graham and Dodd prepare us for the next step. If analysis is about finding the truth of a business, then we need a central guiding star. Something that helps us measure whether a security is really worth buying. That guiding star is the concept of intrinsic value, and it is in Chapter 3 that the authors introduce this core idea. The very heart of security analysis. Chapter 3. The concept of intrinsic value. At the core of security analysis stands one powerful idea: intrinsic value. It is the true worth of a security based on facts, not market emotions. Graham and Dodd explain that market prices are often misleading. Sometimes they are too high, driven by excitement and greed. Other times they are too low, pulled down by fear and panic. But underneath these waves, every business has a real value. That is what the analyst must uncover. So what is intrinsic value? It is not a single number fixed forever. It is an estimate based on careful study of earnings, dividends, assets, and long-term prospects. Think of it as the weight of gold inside a box. The market may argue about the box's decoration, but the analyst wants to know how much gold is inside. For example, if a company regularly earns strong profits, owns valuable assets, and pays steady dividends, its intrinsic value is high. If another company has unstable earnings, heavy debts, and doubtful assets, its intrinsic value is low. The market may confuse these two, but the analyst must see clearly. Why does intrinsic value matter? Because it allows investors to make rational choices. If the market price is far below intrinsic value, the investor has an opportunity. If the market price is far above intrinsic value, the investor faces danger. The gap between price and value creates risk or reward. Graham and Dodd stress that intrinsic value is not about perfection. It is about reasonable judgment. Different analysts may estimate slightly different numbers, but the point is not to be exact to the penny. The point is to have a reliable anchor that guides decisions. This is why intrinsic value is so powerful. It pulls the investor away from market illusions. It forces him to ask, what is this business really worth? Not what people hope it will be worth tomorrow, but what the facts suggest today. However, knowing intrinsic value is not enough. The investor must also understand his own role. Will he act as an investor, guided by logic and safety, or as a speculator, chasing market moods without foundation? This question leads directly to the next chapter, where Graham and Dodd draw a sharp line between investment and speculation. A line that every investor must recognize before risking a single dollar. Chapter 4. Distinctions between investment and speculation. Every investor must face a simple but dangerous question. Am I investing or am I speculating? Benjamin Graham and David Dodd draw a clear line between the two. An investment, they say, has 3 conditions. It is based on thorough analysis. It guarantees safety of principal. And it offers a satisfactory return. If any of these conditions are missing, then the act is speculation. It does not matter what name you give it. It does not matter how confident you feel. Without analysis, without safety, without reasonable return, it is speculation. This definition is not meant to condemn speculation entirely. Speculation will always exist. It can even be exciting and at times profitable. But the real danger is confusion. When speculation disguises itself as investment, investors fall into traps. Consider an example. A man buys shares of a fashionable new company simply because its price is rising. He convinces himself that it is an investment, but he has no analysis of earnings, no idea of risks, no margin of safety. In truth, he is speculating. On the other hand, another man buys bonds of a stable railroad company after careful study. He knows the income record, the assets, the protective covenants. This is investment. It may not bring spectacular gains overnight, but it carries discipline, safety, and reliability. The authors also warn against a subtle trap. Sometimes, what begins as investment quietly turns into speculation. A stock bought for its steady dividends may tempt the owner to hold it during wild price swings, hoping for a quick profit. The line becomes blurred. That is why discipline and honesty are essential. The true investor must constantly ask, am I being guided by facts and principles? Or am I being carried away by hope, fear, or greed? By keeping this distinction clear, investors can protect themselves from ruin. So what lesson does this chapter leave us with? That speculation is not evil, but it is dangerous when misunderstood. Investment is built on analysis and safety. Speculation is built on guesswork and emotion. The wise investor must keep the two separate. And now, with the difference made clear, Graham and Dodd move to the practical world of securities themselves. They turn their attention to the most fundamental type of investment, one where safety of principal is tested most directly: bonds and other fixed-value securities. This marks the beginning of Part 2, the selection of fixed-value investments. Part 2, Fixed-Value Investments. If common stocks are the arena of uncertainty, then fixed-value investments are the fortress of stability. Here, the focus is not on dazzling profits, but on protection of capital. Bonds, debentures, and preferred stocks form this world. Their value lies in their promise of steady payments and their priority claim on assets. Benjamin Graham and David Dodd remind us that the first duty of an investor is not to make money, but to keep money safe. A fixed value investment may not deliver excitement, but it delivers discipline. It builds a foundation on which other, riskier ventures can stand. This part of the book explores how to judge these securities. The authors show that numbers matter. Coverage ratios, earnings history, and balance sheet strength decide whether a bond is truly safe. They also show that legal covenants and contractual promises protect bondholders when companies are tempted to take risks. But this part is not only about numbers. It is about philosophy. The investor must accept that a modest, steady return with safety is better than chasing spectacular gains with danger. A sound bond, paying its interest year after year, may not make headlines, but it can protect an investor through depressions and crashes. At the same time, Graham and Dodd warn that not all bonds and fixed securities are safe. History is filled with cases where investors assumed safety, only to lose everything when earnings collapsed or debts piled too high. Therefore, selection becomes the art and science of the fixed income investor. Which bond deserves trust? Which preferred stock carries real protection? And which seemingly safe issue hides danger under the surface? This is the battlefield of Part 2. It is here that the authors arm us with rules, tests, and principles. Rules that can guide an investor through the maze of securities, keeping him safe from disaster. And the first step is the most important one. How to choose fixed value investments in the first place. What qualities should the investor demand before committing capital? This brings us directly to Chapter 5, the selection of fixed value investments. Chapter 5, the selection of fixed value investments. Now we step into the world of fixed value investments. These are securities like bonds and preferred stocks that promise a fixed return. Unlike common stocks, their income is usually predetermined. This makes them appear safer at first glance, but appearances can be misleading. Benjamin Graham and David Dodd explain that the key question in selecting fixed value investments is not how much they yield. It is whether the principal is safe. The investor's first duty is to protect the original capital. If the return is high, but the principal is at risk, then the investment is not truly sound. The authors stress that many investors are seduced by higher interest rates. They forget that a higher return usually signals higher risk. For example, a shaky company might offer a bond paying 7%. A strong company may offer only 4%. Attractive as the higher rate may look, the weaker company might fail, leaving the investor with heavy losses. So how should an investor choose? The rule is clear. Safety of principal must always come before return. If the capital is lost, even the highest promised interest becomes worthless. The analysis of fixed value investments therefore requires careful study of several factors. First, the stability of the issuing company's earnings. Second, the sufficiency of its assets to cover debts. Third, the presence of protective covenants that limit management from reckless actions. Another important point is the difference between short-term and long-term obligations. Short-term obligations may be paid easily when business is stable. But if earnings fall, the company must still meet its long-term bond interest year after year. The analyst must ensure that the company can handle this burden in both good times and bad. Graham and Dodd also highlight the importance of industry conditions. Even a strong company in a declining industry may face danger. For example, railroads once dominated American finance, but as cars and planes grew, many railroads struggled to pay bondholders. This shows why analysis must extend beyond numbers into the realities of business life. Finally, they remind us that fixed value investments are not meant to make investors rich quickly. Their true role is preservation of wealth and steady income. Chasing unusually high returns in this field almost always leads to speculation. The lesson of this chapter is simple but profound. Select fixed value investments by focusing first on safety of principal. Then look at the adequacy of return. Never reverse the order. And with this foundation, the authors take us one step further. If safety of principal is the golden rule, how exactly do we test it? What standards must be applied to judge whether a bond or preferred stock is truly safe? This critical question is answered in the next discussion. Chapter 6. The Rule of Safety of Principle. Chapter 6. The Rule of Safety of Principle. Safety of principle is the heart of fixed value investing. Benjamin Graham and David Dodd repeat this rule again and again because it protects investors from disaster. The idea is simple but powerful. Before you think about how much you might earn, you must first be sure that your money will not be lost. This principle may sound obvious, yet history shows that many investors forget it. They chase higher interest rates or attractive dividends without asking if the company can truly meet its promises. When trouble comes, those promises collapse, leaving investors with heavy losses. So how do we apply this rule in practice? The analyst must carefully examine whether a company's earnings and assets provide a cushion. Even in bad years, will the company still be able to pay interest on bonds or dividends on preferred stock? If the answer is uncertain, then the investment is not safe. Graham and Dodd emphasize the concept of coverage. This means the ratio of earnings to fixed charges like interest. If a company earns only slightly more than it owes, then a small downturn could wipe out its ability to pay. But if its earnings are many times greater than its fixed charges, then the investor can feel secure. Assets also matter. If a company owns valuable property, machinery, or cash reserves, these can support bondholders during difficult times, but inflated asset values or excessive reliance on intangibles should be viewed with suspicion. The analyst must separate real strength from accounting illusions. Another key aspect is management behavior. A company might have resources, but reckless leaders can destroy safety. Borrowing too heavily, paying out excessive dividends, or engaging in risky expansions all threaten the protection of principal. The authors also caution against blind faith in diversification. Owning many unsafe bonds does not create safety. It only spreads the danger. True protection comes from the quality of each individual investment, not the quantity. Ultimately, the rule of safety of principle is more than a formula. It is a mindset. It requires the investor to think defensively, always prepared for the unexpected. It shifts the focus from maximizing gains to minimizing losses. And in the long run, this defensive posture proves to be the best defense. The chapter closes with a guiding thought. The investor who insists on safety of principle may sometimes accept lower returns, but he also avoids the disasters that wipe out careless investors. In the end, he preserves not only his money, but also his peace of mind. And so the natural question follows. If safety is based on coverage and assets, how do we measure these factors in detail? What numbers should the analyst study, and how should they be interpreted? This leads us directly into the next step of the journey. Chapter 7. Quantitative Factors in Bond Analysis. Chapter 7. Quantitative Factors in Bond Analysis. When we speak about bonds, one thing matters above all. Can the company pay its interest year after year without fail? This is where quantitative analysis becomes critical. Numbers tell the story of a company's strength or weakness. The most important measure is interest coverage. This means how many times a company's earnings before interest and taxes can cover its interest payments. For example, if a company earns 10 million and its annual interest is 2 million, the coverage ratio is 5 times. This shows a strong cushion. But if the ratio is only 1.5 times, the risk increases. A small drop in earnings may cause default. Another key measure is stability of earnings. Bondholders do not care about spectacular growth. They care about consistency. A company with moderate but steady earnings is safer than a company with high profits one year and losses the next. The size of the company also plays a role. Large companies often have more resources, stronger credit, and access to capital markets. Smaller firms may be vulnerable to competition or economic swings. The capital structure must also be studied. If a company already has a heavy load of debt, adding more bonds increases danger. Analysts check the ratio of funded debt to equity. Too much leverage means a small decline in earnings could ruin the company. Asset protection is another factor. Bondholders want assurance that tangible assets like plants, property, or inventory are enough to secure the debt. If earnings fail, assets act as the final safeguard. The analyst must also study profit margins. Thin margins leave little room for mistakes. Wide margins provide flexibility. Finally, industry conditions cannot be ignored. Even a strong company may suffer if the entire industry is in decline. Railroads in the early 20th century are an example. Many had solid histories, but declining revenues made their bonds unsafe. Quantitative analysis, therefore, is not just about checking one ratio. It is about building a complete picture. Earnings coverage, stability, size, assets, debt levels, margins, and industry trends. Together, they show whether a bond deserves confidence or suspicion. But numbers alone are not enough. A bond may look safe on paper and still be ruined by poor management choices. This is why Graham and Dodd stress not only quantitative factors, but also protective covenants written into the bond contract. These legal protections are the focus of the next chapter. Chapter 8. The Protective Covenant. Numbers may reveal the strength of a company, but numbers alone cannot protect investors. That protection often comes from the bond contract itself. This is where protective covenants become essential. A covenant is simply a promise. It is a rule placed inside the bond agreement that restricts the company from taking actions that could harm bondholders. Think of it as a safety lock. Even if management wants to act recklessly, the covenant forces discipline. One common covenant limits the company from issuing too much new debt. Without such a rule, management could borrow endlessly, piling obligations on top of existing ones. This would weaken the safety of earlier bondholders. By restricting new debt, the covenant preserves stability. Another covenant may require the company to maintain certain financial ratios. For example, the ratio of assets to debt must not fall below a set point. If the ratio drops, bondholders gain the right to demand repayment or corrective action. This ensures that the company keeps its balance sheet in healthy condition. Covenants can also control the use of profits. Some contracts require that a portion of earnings go into a sinking fund. This fund is used to gradually pay off the debt before maturity. It reduces the chance of sudden default in the future. There are also covenants protecting against asset sales. A company cannot sell off factories, land, or subsidiaries without ensuring that bondholders remain secure. This prevents management from stripping the company of value and leaving creditors exposed. Other covenants may restrict dividend payments to shareholders. If too much cash is paid out as dividends, less remains to service the debt. By limiting dividends, the covenant ensures bondholders are paid first. These protective rules show us that bond analysis is not just financial science. It is also legal science. The words written in the bond contract can make the difference between safety and disaster. For the cautious investor, studying covenants is just as important as studying financial ratios. Graham and Dodd emphasize that covenants are often ignored by casual investors, but professionals know they are the backbone of bond safety. A weak covenant can turn a seemingly strong bond into a dangerous one. A strong covenant can rescue an otherwise moderate issue. In short, protective covenants are the silent guardians of fixed income investors. They restrict reckless actions, ensure discipline, and guarantee that bondholders are respected. But what about securities that stand between bonds and stocks? Those that promise a fixed return, yet lack the same level of legal safety. This brings us to the next subject: preferred stocks. Their theory, their risks, and the special care they demand will be explored in Chapter 9. Chapter 9. The Theory of Preferred Stocks. Preferred stock is a special type of security. It stands halfway between bonds and common stock. Like bonds, it pays a fixed return, usually called a dividend. Like common stock, it represents ownership in the company. But unlike bonds, preferred stock has no fixed maturity date. And unlike common stock, it usually has no voting rights. At first glance, preferred stock may look safe. It offers a steady income stream. It seems less risky than common stock because dividends are fixed. But Graham and Dodd warn us. Preferred stock is not as safe as many people think. The key problem lies in its position in the company's financial structure. Bondholders have the first claim on earnings and assets. Common stockholders have the last claim. Preferred stockholders sit in the middle. This makes them vulnerable. If the company struggles, bondholders are paid first. Preferred dividends may be skipped without causing bankruptcy. Common shareholders may still hope for growth in the future. But preferred shareholders are left with nothing. So preferred stock carries a hidden risk. It offers limited reward, but still faces danger in hard times. It lacks the strong protection of bonds, and it lacks the growth potential of common stock. Does this mean preferred stock has no place in investing? Not exactly. In certain cases, preferred stock can be justified. If the issuing company has stable and strong earnings, the dividends may be reliable. If protective covenants are strong, preferred holders may gain extra security. Sometimes, preferred shares are created for special financing purposes, like balancing debt and equity. But Graham and Dodd are cautious. They argue that preferred stock is fundamentally weaker than bonds, and it does not provide the flexibility of common stock. It is often issued by companies that cannot safely sell more bonds. This fact alone should make investors alert. Why is the company turning to preferred stock instead of safer financing? Usually, it signals weakness. Therefore, the theory of preferred stock is a warning. Investors must never treat it as a safe, fixed income instrument. It belongs in the category of securities that demand extra careful analysis, which brings us naturally to the next step. If preferred stock is risky in theory, how do we analyze it in practice? What numbers, tests, and methods can reveal whether a preferred issue is truly safe or dangerously weak? These questions lead us directly into Chapter 10. The Analysis of Preferred Stocks. Chapter 10. The Analysis of Preferred Stocks. Now that we understand the theory behind preferred stocks, the next challenge is to analyze them in detail. Graham and Dodd stress that preferred stockholders face a special risk. They depend entirely on the stability of earnings. If a company cannot pay interest on bonds, it defaults. But if it cannot pay dividends on preferred stock, it simply suspends payment. There is no legal protection. The investor is left waiting. So how should preferred stocks be analyzed? The first and most important step is to study earnings coverage. Are the company's earnings large and stable enough to cover preferred dividends many times over? A narrow coverage means danger. Even a single bad year can wipe out payments. The second step is to examine the balance sheet. Strong assets support preferred obligations. If assets are weak or heavily mortgaged, preferred holders have little security. Third, the analyst must look at the history of dividend payments. Has the company maintained preferred dividends through difficult times? Or has it shown a habit of suspending them? Past behavior is often the best guide to future treatment. Fourth, the investor should judge the company's overall financial policy. Does management act conservatively? Or does it take unnecessary risks? A reckless policy can quickly endanger preferred dividends. Graham and Dodd conclude that preferred stocks are often more speculative than they appear. They look steady, but in truth, they can collapse during downturns. This is why the authors are critical of investors who blindly treat them as safe investments. Preferred stocks demand the same careful analysis as bonds, and often even stricter tests. The lesson is clear. Preferred stocks may have a place, but only in rare cases where earnings are strong, covenants are protective, and management is trustworthy. For most investors, bonds offer greater safety, while common stocks offer greater opportunity. Preferred stocks sit uncomfortably in between. And here lies the connection to what comes next. If even preferred stocks carry speculative features, then what about other senior securities that openly combine stability with speculation? What about income bonds, adjustment issues, convertibles, and warrants? These securities blur the line between investment and speculation. Understanding them requires a deeper dive into their technical features and risks. That is exactly what begins in the next section. Part 3. Senior securities with speculative features. Part 3. Senior securities with speculative features. So far, we have looked at securities that promise stability, bonds that protect the principal, preferred stocks that aim to give steady dividends. These instruments are designed for safety. But what happens when even senior securities carry an element of speculation? This is where investing becomes more complex. On paper, senior securities should be the safest. They stand higher in the chain of claims. They receive priority before common stockholders. But reality tells a different story. Many of these securities still hide risks that can surprise the careless investor. Why is this so? Because companies often design securities not just for safety, but also to attract buyers. They add features like convertibility, income-dependent payments, or warrants. These features make the securities more appealing in the market, but they also add uncertainty. Suddenly, what looks like a bond may behave like a speculative stock. Graham and Dodd remind us, the analyst must not be blinded by the title senior security. He must dig deeper. He must ask, what guarantees truly exist, and what elements of speculation are silently present? This part of the book explores that tension between the promise of priority and the reality of risk, between contractual obligations and market temptations, and between safety and speculation. The journey begins with the foundation. Before we can evaluate risks, we must first understand the technical design of these instruments. How do senior securities work in practice? What rights do they give? And what limits do they carry? That is the subject of Chapter 11. The technical characteristics of senior securities. Chapter 11. Technical characteristics of senior securities. Senior securities stand at the top of the financial ladder. They are called senior because they have priority over other forms of capital. This means they get paid before common stockholders. And in times of crisis, their claims are honored first. But what does this priority really mean? And how does it work in practice? The two most common senior securities are bonds and preferred stocks. Bonds are contracts. They obligate the company to pay fixed interest at fixed times. Failure to do so means legal default. This makes bonds appear very safe. Preferred stocks, on the other hand, are not contracts in the same sense. They promise dividends, but companies can suspend these payments if earnings are too weak. Preferred stockholders cannot always force payment through legal action. So even though they rank above common stockholders, they are less secure than bondholders. Another characteristic is claim on assets. If a company fails and is liquidated, bondholders have the first right to company assets. Preferred stockholders come after them. Common stockholders come last. This order of priority defines how safe or risky each class of security is. Then there are protective covenants. These are rules written into bond agreements. They restrict management from taking reckless steps, such as issuing too much new debt or selling assets without permission. Such covenants give bondholders extra security. Preferred stocks, however, often lack strong covenants. This makes them more exposed to management decisions. We also need to consider voting rights. Bonds rarely give bondholders a say in company affairs. Preferred stockholders sometimes gain voting power, especially if dividends remain unpaid. Common stockholders, however, always control the company. This shows that with greater safety often comes less control. Finally, senior securities differ in flexibility of return. Bondholders are locked into fixed payments. They cannot benefit if earnings rise. Preferred stockholders may gain some advantages, but still have limited upside. It is the common stockholders who enjoy the most reward when business thrives. This technical structure reveals a paradox. Senior securities are safer because they have priority and fixed claims. But they are also limited. Their rewards are capped, while their risks, especially for preferreds, can still be significant. So the analyst must understand these characteristics deeply. Without this knowledge, it is easy to be misled by the title senior security, because priority alone does not remove every danger. And this leads directly to the next question. If these securities are supposed to be safe, what factors can make them speculative? What hidden risks turn a senior claim into a gamble? That is the subject of Chapter 12. Speculative factors in senior securities. Chapter 12. Speculative factors in senior securities. In the previous chapter, we looked at the technical characteristics of senior securities. But technical structure alone is not enough to decide safety. Every investment also carries speculative elements, even when it is backed by strong contracts. This chapter focuses on those speculative factors. Senior securities are usually bonds and preferred stocks. They are designed to be safer than common stock. Yet, they are never free from risk. The moment a company faces pressure in its earnings, even senior securities can lose value. Speculation enters through many doors. The first factor is the earnings of the company. If earnings are stable and cover fixed charges many times, the security is safer. But if earnings fluctuate with the economy, the security becomes speculative. A bondholder depends entirely on the ability of the business to pay interest. If profits collapse, bonds can default. The second factor is the industry position. Some industries are naturally stable, like public utilities. Others are highly cyclical, like steel or automobiles. So, a bond issued by a steel company is more speculative than one issued by a water supply company. The third factor is management policy. Even a strong company can be made speculative if management takes reckless risks. If management issues too many bonds, debt levels rise. If they expand aggressively in uncertain markets, earnings become unstable. Thus, investors must judge not only numbers, but also the attitude of leadership. The fourth factor is external conditions. War, regulation, inflation, or depression can shake even the strongest securities. History shows that senior securities are never fully insulated from economic shocks. During the Great Depression, many once safe bonds defaulted. The lesson is clear. Senior securities may look safe, but they can turn speculative depending on circumstances. Investors must weigh both technical features and speculative realities. A wise analyst does not just ask, "What does this bond promise?" He also asks, "How vulnerable is it to forces beyond control?" And this naturally leads us to the next subject. If speculative factors play such a big role, we need to study them in specific industries. The best way to see this is by examining how bonds behave in real cases. And the first case we will explore is the railroad industry. This brings us to Chapter 13, the analysis of railroad bonds. Chapter 13, the analysis of railroad bonds. Railroads were once the backbone of industrial America. In the late 19th and early 20th centuries, they were the lifeline of commerce, moving goods, raw materials, and people across vast distances. Because of their central role, railroad companies became some of the largest issuers of bonds. For decades, railroad bonds were seen as the safest form of corporate investment, almost like government securities. But history teaches us that safety is never permanent. Railroad bankruptcies were not uncommon. Even great systems, with thousands of miles of track, faced financial distress when mismanagement, competition, or economic depression struck. Therefore, analyzing railroad bonds requires more than blind faith in the industry's importance. The first step in evaluating railroad bonds is to examine the stability of earnings. Railroads had heavy fixed charges: wages, maintenance, fuel, interest on debt. If revenues dropped due to recessions, strikes, or overexpansion, companies could not easily cut costs. This made them vulnerable to default. A second factor is the traffic base. Railroads serving diverse regions with mixed freight, coal, agricultural produce, manufactured goods, were more stable than those dependent on one commodity. For example, a line dependent only on coal shipments could collapse if demand for coal fell. Geography also plays a decisive role. Railroads controlling key routes, such as those connecting major industrial cities or ports, had an advantage. Those in remote or sparsely populated areas faced chronic weakness. In finance, location can mean survival. Another consideration is competition. During periods of overbuilding, multiple railroads fought for the same territory. This destroyed profitability, driving some systems into bankruptcy. The presence of parallel lines must always be weighed carefully. Then comes the structure of debt. Railroads often issued bonds secured by mortgages on sections of track, rolling stock, or terminals. But the layers of senior and junior obligations could be highly complex. Analysts must study whether bondholders truly have enforceable claims in case of default. A bond with strong legal protection is far more secure than one buried under multiple prior liens. Finally, one must judge management quality. Railroads required constant maintenance and large reinvestment. A poorly run company could squander even strong revenues through inefficiency or corruption. History records many railroads ruined by reckless expansion or dishonest practices. In short, the analysis of railroad bonds combines earning stability, traffic diversity, geographic importance, competitive position, debt structure, and managerial integrity. Only by balancing all these elements can an investor judge whether such bonds are truly safe or merely appear so. And just as the railroad bond investor must consider the special characteristics of this industry, the same logic applies to another great field of American finance, the public utility companies. In the next chapter, we turn to the analysis of public utility bonds, where the challenges are different, but no less critical. Chapter 14. The analysis of public utility bonds. Public utility companies provide essential services. Electricity, gas, water, and transportation form the backbone of daily life. Because their services are needed no matter the economy, their bonds often seem safer than those of industrial companies. Investors are naturally attracted to utilities for this perceived stability. But the surface safety of public utility bonds hides complexities. Earnings are generally more predictable than railroads, yet they are often constrained by government regulation. Rates charged to consumers must be approved by public authorities. This limits profits, but it also protects investors from extreme losses. The first step in analysis is to examine revenue stability. Utilities with monopolistic or near-monopolistic positions have steady cash flows. Competition is usually limited, making income more predictable. However, rising operational costs or unexpected maintenance can strain finances even in strong companies. Second, the capital structure of the utility matters. Many utilities have significant debt to finance infrastructure. Senior bonds secured by property or equipment provide relative safety, but excessive leverage can make a company vulnerable to interest rate changes or declining revenues. Third, regulatory environment is critical. Governments can impose rate ceilings or enforce service obligations. While this protects the public, it may reduce profitability. An investor must understand how rules affect both earnings and the ability to pay interest. Another consideration is asset quality. Infrastructure such as power plants, pipelines, and transmission lines must be maintained. Deferred maintenance or poor investment planning can erode the bond's safety over time. The balance between depreciation and upkeep is a subtle but essential factor. Management quality is also vital. Experienced leadership ensures that capital projects are completed on time and within budget. Poor decisions can turn a seemingly secure bond into a speculative risk. Lastly, the analyst must consider economic and technological change. New energy sources, environmental regulations, or shifts in consumer demand can alter the utility's revenue prospects. Even a well-managed company with a monopoly is not immune to change. In essence, public utility bonds combine the promise of stability with unique regulatory and operational risks. The intelligent investor must weigh these factors carefully. Unlike railroads, where competition and traffic dictated risk, in utilities the rules, management, and regulatory environment dominate. Once we understand public utility bonds, the next step is to look at industrial bonds. Industries outside utilities and railroads behave differently, with distinct risks and opportunities. This leads naturally to Chapter 15, Industrial Bond Analysis, where we examine how to evaluate bonds in the broader corporate world. Chapter 15, Industrial Bond Analysis. Industrial bonds are issued by companies engaged in manufacturing, mining, and other commercial activities. Unlike railroads or utilities, these companies face far more volatile markets. Their earnings depend heavily on economic cycles, consumer demand, and global conditions. This makes industrial bonds inherently more speculative than many senior securities. The first factor in analyzing industrial bonds is earnings stability. A company with predictable profits over multiple years is safer. But industries like steel, textiles, or automobiles experience booms and busts. An investor must assess how the company has weathered past economic downturns. Second, the capital structure matters. Industrial companies often carry multiple layers of debt. Senior bonds are prioritized in claims, but junior bonds and preferred stocks increase financial complexity. High leverage can amplify both risk and reward. The analyst must determine whether the company can meet interest payments under stressed conditions. Third, asset quality plays a crucial role. Factories, machinery, and inventories must be real, properly valued, and maintained. Overstated or obsolete assets can mislead investors about the true security of the bond. Fourth, market position and competition are vital. A leading company with strong brand recognition and market share is better able to maintain earnings during economic slowdowns. Companies in highly competitive or declining markets are riskier. Management is another key factor. Industrial firms require experienced leadership capable of controlling costs, expanding efficiently, and responding to market changes. Mismanagement can turn a technically strong bond into a speculative gamble. External conditions also influence risk. Economic recessions, raw material price fluctuations, and international trade issues can affect earnings. Even the best analyzed bond can be impacted by factors beyond control. Analysts must also consider protective covenants in bond agreements. These may restrict new debt, limit dividend payments, or enforce minimum liquidity. Strong covenants increase safety. Weak ones leave the bond more exposed. In essence, industrial bonds offer opportunity, but demand careful evaluation. Unlike railroads or utilities, risk depends less on regulation or monopoly, and more on the company's ability to survive economic cycles. Understanding industrial bonds prepares us for a more complex category. Some securities do not pay fixed interest, or their payment depends on company income. This introduces a new challenge. The next chapter explores these complexities in Chapter 16, The Theory of Income Bonds and Adjustment Issues. Chapter 16, The Theory of Income Bonds and Adjustment Issues. Income bonds are a unique type of security. Unlike traditional bonds, they do not promise fixed interest payments. Instead, payment depends on the earnings of the issuing company. If the company earns enough, bondholders receive interest. If earnings are insufficient, payment may be skipped without legal default. At first glance, income bonds may appear risky. There is no guaranteed income. Yet they are designed to help companies during financial distress. By linking payments to profits, companies avoid bankruptcy while providing bondholders a chance to earn if recovery occurs. Analyzing income bonds requires a careful look at company earnings. The analyst must estimate future profits under realistic conditions. Past performance provides clues, but it is never a guarantee. Even small fluctuations in income can dramatically affect the safety of the bond. Next, adjustment issues arise when a company restructures its debt. Debt may be converted into income bonds, or senior bonds may be subordinated. Analysts must study these adjustments to understand who truly has priority and how risk shifts among creditors. This often requires reading legal documents and corporate agreements carefully. Another factor is the company's ability to recover. Income bonds work best in firms with sound assets, but temporary earnings problems. If the company is fundamentally weak, income bonds may become worthless. Investors must also consider market perception. Income bonds may trade at a discount, reflecting both risk and potential reward. Speculative investors may be attracted, but prudent analysts focus on underlying fundamentals. Finally, income bonds highlight a broader truth. Not all senior securities behave the same way. Some are fixed and predictable. Others are income-dependent and speculative. Understanding the difference is essential for sound investment. Once we understand income bonds and their adjustments, we are ready to explore convertible securities and warrants. These instruments combine features of bonds and stocks, offering opportunities but also adding complexity. This naturally leads to Chapter 17, the analysis of convertible issues and warrants. Chapter 17, the analysis of convertible issues and warrants. Convertible securities are unique instruments that combine characteristics of both bonds and stocks. A convertible bond pays fixed interest like a regular bond, but can be exchanged for a predetermined number of common shares. Warrants, on the other hand, give the holder the right to purchase stock at a fixed price for a specific period. The appeal of these instruments is obvious. They offer the safety of a bond with the potential upside of stock ownership. Investors gain income through interest while also keeping the option to benefit from company growth. But this combination of features also introduces complexity and risk. The first factor to consider is conversion terms. The conversion ratio determines how many shares the bond can become. A favorable ratio increases the potential for profit, while an unfavorable ratio may reduce the value of the security. Second is market conditions. If the company's stock performs poorly, conversion is less attractive. The investor may choose to hold the bond for interest, but this limits gains. If the stock rises dramatically, conversion becomes highly valuable. Understanding market potential is critical. Next is credit risk. Even a convertible bond is still a debt instrument. The company must pay interest and principal if conversion does not occur. Default risk exists, especially in weaker companies. Warrants add another layer of complexity. They are highly sensitive to stock price movements. Small fluctuations in the underlying stock can greatly impact their market value. Warrants may expire worthless if stock prices do not reach the exercise price. Analysts also examine interest rate sensitivity. Rising interest rates can reduce the market value of bonds, including convertibles. This affects potential returns and the attractiveness of conversion. Finally, management policy and company fundamentals matter. A company with strong earnings and growth prospects makes conversion more appealing. Poorly managed firms increase the speculative nature of these securities. In essence, convertibles and warrants illustrate the blending of safety and speculation. They offer the potential for higher rewards, but require careful analysis. Investors must evaluate the bond-like safety, the stock-like upside, and all underlying risks. With this understanding of convertibles and warrants, we conclude Part 3. The next section, Part 4, Theory of Common Stock Investment, shifts focus entirely to stocks. Here, the stakes are higher, risks are greater, and potential rewards are far more dramatic. I'm going to wrap up this video here because this book has 43 chapters, and covering all of them in one go would make it way too long. Don't worry though, the next part will be uploaded next Sunday, so stay tuned. If you found this video helpful or interesting, make sure to subscribe, and if you haven't hit the like button yet, now's the perfect time. It's free for you, but it really helps the channel grow. Thanks for watching, and I'll see you soon.